Good morning. My name is Carol, and I will be your conference operator today. At this time, I would like to welcome everyone to the Carmax Fiscal 2021 Fourth Quarter and Year-End Earnings Conference Call. All lines have been placed on mute to prevent any background noise. After the speaker's remarks, there will be a question-and-answer session. I would now like to turn the call over to Stacy Frole, Vice President, Investor Relations.
Good morning. Thank you for joining our fiscal 2021 fourth quarter and year-end earnings conference call. I'm here today with Bill Nash, our President and CEO, Enrique Mayor-Mora, our Senior Vice President and CFO, and John Daniels, our Senior Vice President, CAF Operations. Let me remind you, our statements today regarding the company's future business plans, prospects, and financial performance are forward-looking statements we make pursuant to the Safe Harbor provisions of the Private Securities Litigation Reform Act of 1995. These statements are based on management's current knowledge and assumptions about future events that involve risks and uncertainties that could cause actual results to differ materially from our expectations. In providing projections and other forward-looking statements, the company disclaims any intent or obligation to update them. For additional information on important factors that could affect these expectations, please see the company's Form 8-K issued this morning and its annual report on Form 10-K for the fiscal year ended February 29, 2020, filed with the SEC. Should you have any follow-up questions after the call, please feel free to contact our Investor Relations Department at 804-747-0422, extension 7865. Lastly, let me thank you in advance for asking only one question and getting back in the queue for more follow-ups. Bill?
Thank you, Stacy. Good morning, everyone, and thanks for joining us. We have a lot of exciting news to cover today. Our comments will focus on material fourth quarter and fiscal 2021 performance insights, updates on our digital enhancements, and of course, the Edmunds acquisition, which we announced this morning. Then we will open it up for your questions. For the quarter, total retail used unit sales were down less than 1% from last year's record sales, and used unit comps were down 2.3% when compared with the same period a year ago. It's worth spending a moment on the events driving our results for the fourth quarter. As we discussed on our last call, entering the quarter, retail sales were pressured due to a surge in COVID-19 cases, which tightened occupancy restrictions and shelter-in-place orders. Sales began to accelerate towards the end of December and into January. By the beginning of February, we were trending towards mid-single-digit comp growth for the quarter, excluding the impact of leap day in the prior year. However, starting in the middle of February, retail sales were affected by the severe winter weather across a large portion of the U.S., closing more than 65 stores in one day. Sales were also impacted by delays in tax refunds relative to last year's timing and a lower inventory position due to COVID and weather-related production constraints. On a two-year stack, total retail used unit sales for the fourth quarter of FY21 were up 13.8%, and used unit comps were up 8.7%. March sales were robust when compared with both COVID-impacted March last year and a record March in 2019. During the month, the initial distribution of tax refund and stimulus checks began, weather improved, and customers continued to respond favorably to our ongoing digital enhancements and other strategic initiatives. In addition, the underlying metrics we track, including website visits, online progression, and activity at our Customer Experience Centers, or CECs, indicate continued healthy demand for used vehicles as we head into April. Full-year market share data indicates that our share of 0 to 10-year-old vehicles in our current comp markets fell from approximately 4.7% in 2019 to 4.3% in calendar 2020. We had strong momentum entering the year, and we're gaining significant market share up until the start of the pandemic, when 95% of the country was under shelter-in-place orders and approximately half of our locations were closed or under limited operations. As markets reopened and our omnichannel experience was launched nationwide, we began gaining market share again. During the last 5 months of 2020, we saw market share gains, and we expect those gains to accelerate in 2021. Atlanta, where we have been in operation since 1995 and our most mature omnichannel market, continues to outperform the company, maintaining its market share in 2020 despite pressure from COVID. During the last 5 months of the calendar year, our market share in Atlanta increased 13.8% Over the past 2 years, since we first introduced our omnichannel experience, our market share in Atlanta has increased 10.9%. Retail gross profit per used unit for the fourth quarter was $2,086 compared with $2,195 last year. This GPU is consistent with our expectations and commentary on the last quarter's call. It reflects the impact of the expanded pricing and marketing tests we rolled out in select markets in combination with our national multimedia marketing campaign and the improvements to our omnichannel experience. Early results for these tests were positive, so we expanded to more markets in the quarter. We're going to continue with testing while also monitoring macro factors. We expect to maintain attractive margins above $2,000 in the first quarter. Enrique will provide additional details around the profitability flow-through on different aspects of our business that are contributing to the success of these tests in just a moment. Our wholesale business delivered another good quarter when you consider the impact of one less auction day compared with the same period last year. For the fourth quarter, wholesale volume was down 1.2%. Wholesale gross profit per unit was comparable to the prior year at $990 per unit. We estimate the one less auction day in this quarter impacted the number of wholesale units sold by several percentage points. Now I'd like to turn the call over to Enrique to provide more information on our fourth quarter financial performance, and then to John, who will provide additional detail around customer financing. Enrique?
Thanks, Bill, and good morning, everyone. For the quarter, other gross profit decreased $4 million, or 3.2%. This decrease was due to a $14 million reduction in service profits, driven largely by our previously announced year-end thank you bonus for 22,000 full and part-time associates across the company, many of whom work in our reconditioning and service functions. Bonuses related to production blitzes and company support pay related to COVID. Partially offsetting this was favorability in EPP and third-party finance fees. EPP grew $2.6 million year over year for the quarter, driven by a favorable reserve adjustment and an increase in profit-sharing revenue. This was partially offset by lower sales volume and a slightly lower penetration rate in the quarter. Third-party finance fees improved by $7.7 million in the quarter, primarily due to the renegotiated fees with our partners, which John will talk about shortly. For SG&A, expenses for the fourth quarter increased 14.7%, or approximately $71 million, to $556 million. SG&A per unit was $2,713, a year-over-year deleverage of $368 per unit on the quarter. The increase in SG&A was primarily driven by an increase in stock-based compensation of $33 million, or a deleverage of $160 per unit, an increase in advertising expense of $23 million, or a deleverage of $115 per unit, which was in line with our previously communicated expectations as we focused on heavier support for our next brand campaign and continued spending to advance our technology platforms and strategic initiatives. Our approach to SG&A and costs heading into next year remains consistent. We will continue to invest in our business at this inflection point in our industry, specifically in marketing and in our strategic initiatives. Regarding marketing, as we head into next fiscal year, we expect our spend to remain elevated with similar per unit trends experienced in the second half of fiscal 2021. Our advertising spend will continue to focus on clearly differentiating our brand and demonstrating the benefits of our omnichannel experience, in addition to ROI-based digital investments that are delivering strong results. Included within this spend is an increased focus on vehicle acquisition. We believe we are well positioned to aggressively grab market share through the promotion of our omnichannel experience and new product offerings, such as Love Your Car Guarantee. We also remain focused on ensuring we are appropriately managing our spend, targeting specific areas of opportunity. This includes our CECs, which are maturing and becoming more efficient and effective through automation, data-driven algorithms, and smart routing with the goal of ensuring customers get the right support. This past year, our CECs were more efficient than the prior year, and we expect this trend will accelerate in FY22. Regarding our SG&A leverage point in FY22, we would expect to require a 5 to 8% comp on a 2-year stacked basis in FY22 to lever in FY22. As previously communicated, in periods of investment like we are in now, we'll need to be at the higher end of the range to lever. This 2-year comp approach is reflective of the impacts of lapping over COVID and due to the continued investments in the business we made this past year. Now I'd like to take a moment to provide an update on the financial aspects of the pricing tests we ran in the fourth quarter. As Bill mentioned, we like what we have seen so far. While these tests confirm what we have historically seen regarding price elasticity, several factors have changed, resulting in a stronger flow-through from the increased sales and thereby resulting in greater profitability. These factors include higher profitability levels of our CAF originations, our lower variable cost structure as we continue to leverage our centralized CECs, and the favorable changes to our third-party lender fee structure. As mentioned earlier, we will continue to perform pricing tests in the first quarter while also monitoring macro factors. Our goal remains to maximize both unit sales and long-term profitability. Our unique and diversified business model still generated a significant amount of cash this past year, despite a challenging environment. From a capital allocation perspective, this positions us well to reinvest in the growth of our core business, fund new growth opportunities such as our announced acquisition of Edmunds, and return capital back to our shareholders. Regarding Edmunds, we expect to pay for the transaction with a combination of cash and equity. We anticipate this transaction will close in June and expect their financials to have an immaterial impact to Carmax's EPS in fiscal year 22. We are confident this transaction will provide significant shareholder value creation over the longer term. We continued executing our share repurchase program, and during the fourth quarter, we repurchased approximately 700,000 shares for $66 million. We currently have $1.34 billion of authorizations remaining, and we are committed to returning capital back to our shareholders. For capital expenditures, we anticipate approximately $350 million in FY22. As we've pivoted our business to be more technology-driven, the profile of our CapEx has followed suit. Approximately 1/3 of our capital spend in FY22 will be focused on investments in technology, up from about 15% just 4 years ago. In FY22, we plan to open 10 new locations, with the first grand opening expected later this month. As was the case with our more recent openings, these locations are predominantly cross-functional stores and have a smaller footprint and can leverage our scale and the presence of other locations in nearby markets. Our national footprint and nationwide logistics network continue to be a competitive advantage for Carmax, and we remain committed to an appropriate level of investment on these differentiated assets. We are confident that the foundational investments we are making in our omnichannel experience, our proprietary tech stack, and our highly recognizable and trusted brand set us up for accelerated market share gains in 2021. Now I'd like to turn the call over to John.
Thanks, Enrique, and good morning, everyone. Carmax Auto Finance and our lending partners once again delivered solid results. For the fourth quarter, CAF's penetration, net of 3-day payoffs, was 43.5%, compared with 43% a year ago. Tier 2 was up slightly to 21% of used unit sales, compared with 20.5% last year. Tier 3 accounted for 9.5%, compared with 10% a year ago. This distribution across the credit tiers is primarily reflective of the credit mix of applicants observed in the fourth quarter. Year over year, CAF's net loans originated were comparable to the prior year quarter at $1.8 billion. The weighted average contract rate charged to new customers was 8.5%, up from 7.9% a year ago and down slightly from 8.6% in the third quarter. Similar to the third quarter, this year-over-year difference in APR is attributed to the mix of CAF customers seen within the Tier 1 space, rather than an increase in the rate charged to these customers. Regarding the portfolio, the overall interest margin increased to 6.4% versus 5.8% in the same period last year, as we continue to realize significant benefit from lower funding costs. Our most recent securitization in January closed with a near record spread between the APR we charge to customers and the rate we pay to fund the receivables. Our ABS investors continue to recognize the consistency and performance of the Carmax origination channel, and we appreciate their support. CAF income was up 68% to $188 million in the quarter, reflecting a reduced loss provision plus an increase in interest margin. The provision for loan losses was $5 million, resulting in an ending reserve balance of $411 million for the fourth quarter. The total reserve is 2.97% of managed receivables, which is lower than the 3.17% at the end of the third quarter. Our reserve as a percentage of managed receivables has trended downward over the past 3 quarters as our customers have exhibited a willingness to make payments even in these continued challenging times. We believe our current reserve is adequate and considers both the positive payment behavior recently observed as well as the future uncertainty of the macro environment. I would also like to provide an update on the arrangements we have with our third-party lenders that Enrique referenced earlier. Our agreements with our partners have resulted in Carmax historically receiving a $300 participation fee for each of the agreed-upon finance contracts purchased within the Tier 2 space. Within the more subprime Tier 3 space, where CAF keeps approximately 5% of the volume, Carmax has historically offered lending partners a $1,000 discount for providing financing to a customer that we believe would otherwise not be able to purchase a vehicle from Carmax. At the beginning of the fourth quarter, this Tier 2 participation fee increased to $400, and our Tier 3 discount was reduced to $750. If this structure had been in place for the entirety of FY21 and penetration rates remained the same, it would have resulted in annual savings of approximately $30 million or $40 on a per unit basis. With regard to future changes in the Tier 2 and Tier 3 space, as of March 2021, CAF has begun to methodically increase its percent of Tier 3 volume beyond the 5% level, and we anticipate reaching and maintaining a 10% share in Tier 3 by May 31st of this year. Carmax will continue to evaluate the lending environment and will consider future adjustments if and when we believe those changes are sustainable and in the best interest of our long-term business goals. Bill?
Thank you, John. Thank you, Enrique. Our 2021 fiscal year was one of the most challenging operating environments we've ever faced. But due to our ability to act quickly in rapidly changing circumstances, we delivered new customer experiences and continued to innovate while remaining financially strong. That financial strength has enabled us to continue to aggressively invest in our core business and pursue new growth opportunities. Some highlights from this year that will have a lasting impact are as follows. The completion of the national rollout of our omni-channel experience, giving us a common platform across all of Carmax that leverages our scale, nationwide footprint, and infrastructure. The move of all wholesale auctions into a virtual environment. The national expansion of our new online instant appraisal offering on Carmax.com and Edmunds.com, strengthening our leadership as the largest buyer and positioning us to become the largest online buyer of used autos from consumers. And finally, the introduction of the Love Your Car Guarantee, an industry-leading signature customer experience. All of these were possible because of our exceptional associates. They came together to take care of each other and our customers while also innovating for the future. Customer response to our omni-channel offering is strong, and we're continuing to work to further improve and enhance the digital customer experience at every step of the sale. One critical advantage of our omni-channel model is the ability for the customer to choose how they progress their experience. As previously discussed, our initial rollout of our omni-channel platform enabled customers to buy a vehicle online. But parts of the transaction may have required assistance from our CECs. In the fourth quarter, we made significant progress enabling self-service for all components of the sale. Exiting the quarter, approximately 25% of our customers were eligible to buy a vehicle online independently if they chose, up significantly from the third quarter. We expect most of our customers to have this ability by the end of the second quarter. Additionally, in Q4, about 3/4 of our customers advanced their transaction digitally, with approximately 5% buying the vehicle online. We consider an online purchase to be when all major activity leading up to the purchase is performed independent of our stores. We expect our online sales will grow robustly as we continue to enhance our marketing and digital capabilities. As a reminder, we will be hosting a virtual Analyst Day on May 6th, where we will take a deeper dive into our online capabilities and our technology and data advantages. At that time, we will also discuss new metrics around online orders and how they are fulfilled, as well as providing insight on our longer-term outlook and expectations. Now, I'll take a moment to highlight some recent enhancements we have made to the customer experience. First is our online instant appraisal offer, which allows us to quickly give customers an offer on their vehicle. This offering was first introduced and tested on Edmunds.com in June. In February, we completed the national rollout of this offering on Carmax.com. Early response has been strong, with online buys quickly exceeding our expectations, providing us with a clear pathway to become the largest online buyer of used autos from consumers. At the end of the fourth quarter, we launched the ability for customers to get penny-perfect transactable financing offers in our online checkout process. With this enhancement, customers can apply and accept finance offers without needing the assistance of an associate to submit a credit application over the phone or in the store. We are rapidly expanding this feature to our overall customer base in the first quarter. We know our customer-centric approach is a differentiator for CarMax, and we will never stop innovating on behalf of our customers. In January, we introduced our new industry-leading signature customer experience, Love Your Car Guarantee. This gives customers the ability to take 24-hour test drives before committing to purchase and extends our 7-day money-back guarantee to a 30-day money-back guarantee, which is unmatched in the automotive industry. It's too early to identify trends, but preliminary results show these offerings are highly valued by our customers. As we continue enhancing our online experience and offerings, it's important to educate our customers on our omni-channel experience to differentiate and elevate the CarMax brand and our position in this evolving marketplace. In the fourth quarter, we introduced the next phase of our national multimedia marketing campaign that began last year to increase awareness of our core omni-channel capabilities, which was highly successful. We set records every week for web visits since being introduced, reaching more than 8 million weekly visits by the end of February. After the campaign launch, web traffic and Google query volumes were both up over 25% versus the prior months. We want to continue this momentum and ensure customers understand that CarMax offers the ultimate flexibility to shop and buy on their terms, their way. Accordingly, as Enrique mentioned earlier, we are planning on increasing our spend in both awareness and acquisition marketing in FY22. We will continue to evolve our business as an omni-channel retailer by innovating at an accelerated pace, leveraging our scale across technology, data, talent, and physical assets to unlock opportunities to compete across the used auto ecosystem. This is where we're excited to announce that we've signed a definitive agreement to acquire Edmunds, one of the most influential and popular automotive research sites in the world. Over the past years, our teams have had the opportunity to collaborate with Edmunds on a number of strategic initiatives, including our instant online appraisal offer and leveraging its proprietary content on Carmax.com. We've been extremely impressed with its technology, content, and online experience, as well as its talented tech and creative teams. We believe we can both unlock additional value by working together to streamline the user experience across the entire car buying and selling journey, in addition to identifying other digitally focused opportunities. One thing that has become clear is that we share a commitment of delivering the highest quality online experience to our customers and dealers. Edmunds is a widely recognized and deeply trusted brand. It will continue to operate its core business independently and will remain focused on delivering confidence to consumers and excellent value to its dealer and OEM clients. We are confident this transaction will drive shareholder value as we're able to leverage our combined size, scale, and extensive industry expertise for the benefit of both businesses. To sum up, we are very proud of our performance during this difficult year. We're even more excited about how our continued investments in our existing business and in Edmunds are positioning us to be further differentiated and even more competitive. We expect robust top line, bottom line, and market share growth for the upcoming year that is a result of not only lapping COVID, but demonstrating the impact of the investments we've made and the experiences we are providing. At this point, we will be happy to take your questions. Carol?
Thank you. As a reminder, in order to ask a question, please press star, then the number 1 key on your telephone keypad. To allow for as many questions as possible, we ask that you please limit yourself to 1 question. You may then re-enter the queue for any additional questions. Your first question this morning comes from Sharon Zackfia from William Blair. Please go ahead.
Hi, good morning. I have 2 questions, but I think the first is pretty fast. Your inventory's gone down a lot in March, kind of an unusual amount. Can you talk about how you're positioned from an inventory perspective to meet demand and whether there will be any kind of unusual costs this quarter to ramp back up inventory? And then the second question was on CAF and the expansion of Tier 3. Can you give us any idea of what the profitability is of Tier 3 on a per-car basis relative to the $750 that you discount to the third-party lenders?
Okay, good morning, Sharon. First of all, I'll talk about the inventory, and then I'll let John talk about the CAF question. So you are right. At the end of the quarter, our saleable inventory is low. But again, that is a function of the fact that we had some COVID and weather shutdown. So in the rise in COVID, we had to shut down some production locations. We also had some production locations shut down because of the weather. And so that's really why we're a little bit behind on saleable inventory. At the end of the quarter, I think we were down about 20% on saleable inventory. I would just point out, though, that if you look at our overall inventory year over year, we're actually up a little bit. So we've got the inventory. It's just a matter of producing. In fact, I think we ended the quarter, north of 155,000 units. So it's just a matter of working through that, and we're confident. We have the capacity. Now it's just a matter of getting the inventory back to our target. So, and then I'll let John answer the CAF question.
Yeah, Sharon, thanks for your question. On Tier 3, moving from 5 to 10% for CAF, the profit per unit on that vehicle is relatively consistent to our Tier 1 vehicle. It'll sit, depending on funding costs, between $2,000 and $2,500 in this funding environment. We'll see how it plays out over the course of the year. And you can compare that to the $750 we would pay in a discount. I think an important point to note here is, though, because of CECL regulation, we will have to, as we book those loans, reserve for the full loss impact of that immediately. And so therefore, this will probably be a headwind for us in the upcoming year, but obviously the lifetime profit will play itself out over time.
Can I just ask a follow-up? So on your website right now, it says there are 24,500 cars. Is there some disconnect there between what's on the website versus what you actually have?
Yeah, so Sharon, on the website, all of it you're seeing right now is saleable inventory. We have very little that we put as far as coming soon. What you don't see on there are customer transfers. You don't see the transfers that are going between stores, so say a hub store and a satellite. You don't see sale pending. If you took all that into consideration, you'd actually at least double the number that you currently see on the website. And then, of course, it doesn't include the work in process, which is really what gets you to about the 150,000 total units that we have.
That's super helpful. Thank you.
Sure. Thank you, Sharon.
Your next question comes from Craig Kennison from Baird. Please go ahead.
Hey, good morning. Thanks for taking my question. Bill, you've said that you want CarMax to be the largest buyer of used autos from consumers. What is your estimate for that total addressable market in terms of the number of cars? And then on a related note, can you share any metrics to illustrate your activity levels or your buy rate activity on the online appraisal tool that you're using to source those cars?
Sure. Good morning, Craig. So first of all, let me just clarify something. It's not that I want to be the largest buyer of used cars from consumers. We're already the largest buyer of used cars from consumers. I certainly want to continue to buy every single one that we can. If I think about the total addressable market, 40 million used cars change hands every year. And in that number, obviously, is person to person. So, that's how I kind of think about the overall market. And as far as the online appraisal offer, yeah, we're really excited about this. It's exceeding our expectations. On Carmax.com, we really got it up kind of middle of February, so we only have the partial month. And obviously, we've been testing it, so we had seen some trends before that. But if I look at the quarter as a whole, the online buys were about 10% of the total appraisal lane buys that we made. And of that, just because we got the Carmax.com up, towards the end of the quarter. Most of those buys came through our relationship with Edmunds. But as I said, just the trajectory where we see those things going, we think in very short order we'll buy more than anyone else online from consumers.
Thank you.
Thank you, Craig.
Your next question comes from John Murphy from Bank of America. Please go ahead.
Good morning, guys. I just want to kind of maybe stay on this line of questioning on sourcing vehicles. I mean, obviously the market itself is very tight right now without a lot of flow into the secondary market, the used market. But there's also a lot of dealers and maybe even some new competition that are grabbing vehicles or buying vehicles as well to resale, and particularly with the new vehicle dealers, they're higher in the funnel and getting access to some trade-ins, obviously, as people are selling new vehicles. So, Bill, I'm just curious, as you think about this going forward, how much of this tightness in supply that you can get, for yourselves to retail is transitory, and how much of it is, somewhat more of a secular shift and an increased focus by the dealers and maybe other competition, and it's just making it a little bit harder to get inventory? And then also, is this Edmunds purchase or acquisition really, the key here is focused on sourcing vehicles online? Is that really what this is? Because I know it's a big lead generator for a lot of dealers, so there's a lot of other angles to what Edmunds delivers, but is the key to you sourcing these vehicles directly from the consumer online?
All right, John, I'll try to hit all this. You got a lot of stuff in there. First of all, as we've been talking about for several quarters, vehicle acquisition is a strategic initiative that we've been focused on. And to your point, if you look at the supply out there, the supply has probably gone down a little bit versus prior years. The great thing for us is that we get such a large amount through the appraisal lane. It really helps to alleviate anything outside of CarMax. Our focus with the online is to continue to drive as much as we can of buying vehicles right from the consumers. And we see this as a potential to really increase our self-sufficiency, which we think is a huge competitive advantage. And again, it's one of the reasons why we've been focused on it and will continue to invest in here. Now, as far as Edmunds goes, look, the online piece of Edmunds, that's only a small piece. It's only a small benefit of the whole transaction. That's not the reason that we have decided to acquire Edmunds. It absolutely has been a successful partnership on that piece of it, and we think there's a lot of opportunity still do on the acquisition. But there's other components. We've been working with the content, for example. There's other things at Edmunds that we feel like having the two companies come together will take two great companies and strengthen both of them. So self-sufficiency and buying through the A-lane, increasing that, whether it be through online or through the traditional A-lane, is absolutely a focus for us going forward.
Yeah, it's important to remember as well that we buy cars better than anybody. We always have and will continue to do so. All we're doing now is that we're extending that to online. So the combination of in-store and online, we're just going to continue doing that better than anybody.
Can you guys just give us an idea of where you think you will go in sourcing vehicles directly from the consumer as opposed to auctions? I know we've traditionally thought around 50-50, but different times it kind of ebbs and flows. I mean, is this the kind of thing where you're going to go to 60 to 70 to 80% source from consumers and move away from auctions?
So, John, the way I think about it is more on the self-sufficiency side. Well, first of all, whether it's a retail car or a wholesale car, we want them all. But I think when I think about from the self-sufficiency side, we've been somewhere in the, let's call it the 35 to 50% self-sufficiency over the let's call it the last 5 years. I would expect this to take us to numbers that really are historic highs, if not kind of breaking the ceiling on the self-sufficiency. So our goal is to continue to see how far we can push that number on the north side.
Very helpful. Thank you.
Thank you, John.
Your next question comes from Seth Basham from Wedbush Securities. Please go ahead.
Thanks a lot, and good morning. Bill, I was hoping you could provide some more color around the price tests. How broadly do you expect to extend those? What have you learned in terms of the sweet spot for discounts, and how much lift are you seeing from tests thus far?
Yeah, so Seth, I'll talk a little bit about kind of the extent of the test, and I'll let Enrique just talk about the focus here. But so as I said in the comments, we did expand the test We have the test in a bunch of stores. Now, I would say that we never will expect to do this in all the stores. It just doesn't make sense. And we know the differences between markets and different stores, and the elasticity is very different in different markets. So, as I also said in my opening remarks, we're going to continue with this into the first quarter, but we're going to monitor the macro factors. And obviously, there's a lot going on right now as far as from a macro standpoint. We talked a little about in John's question that while the supplies tighten up a little bit, you got some things going on the new car side as far as new car availability. We've got tax refunds that are going that have been delayed and kind of pushing into March. You got stimulus money out there, so there's a lot of different things kind of going on. Also, macro factors you have to watch or just continue to monitor what your competitors are doing, and whether that's their sales price or their margins. You have to take all that in consideration. So we'll continue with these, like Enrique said earlier. We're pleased with them, but I'll turn it over to Enrique and let him just expand on some of the profitability stuff.
Yeah, absolutely. So, it's important to remember we're solving for two things, right? We're solving for driving increased sales through lower prices, but at the same time, we're also driving for increased profitability. And what we've seen in this test is really two things. One is the same level of sales elasticity. However, what we've seen is greater profitability flow through. And there's really kind of two reasons why we've seen that greater flow through. Number one is higher finance income. So CAF originations much more profitable in this environment, as well as the renegotiated third-party finance fees. And the second is just lower variable costs as we migrate towards our CECs. And so we've been really pleased with the results. We've seen, again, increased sales and increased profitability. So we expect to continue to test, and as Bill mentioned, while also watching the macro environment.
That's helpful. Just as a follow-up, when do you expect to have better data on whether or not you plan to roll this out across the chain? Obviously, this is a unique period of time with all the macro factors you mentioned. Could this be a multi-quarter test before you have a clear picture?
Yeah, I think it's a great question, Seth. Just because of those macro factors, we generally, we get reads on these very quickly. Like I said, we got to read it. We like the results, but again, we got to see how the rest of this quarter shapes up it's more the macro factors versus kind of internally. So I would stay tuned on that. I think we'll probably have an update on that in the Analyst Day in May.
Understood. Thank you.
Thanks, Seth.
Your next question comes from Brian Nagel from Oppenheimer. Please go ahead.
Good morning.
Morning.
Thanks for all the color today. So I've got a couple of questions. I'll merge them together. First off, just with regard to, Bill, you talked about the business into, into the fiscal Q1 or March. Could you help size better just that sales reacceleration, particularly against you thought it was kind of a mid-single digit used car unit increase in February until the weather hit. And then the second question I have, a bit unrelated, but with regard to the renegotiation of the fees in the finance business, those of us who've watched Carmax for a long time, we've talked about this for a long time. Why now? I mean, what allowed you as a company to make this shift at this point?
Great, Brian. I'll let John talk about the CAF in just a moment. I can't believe it's taken us like 5 or 6 questions for somebody to actually ask about the sales performance, but I appreciate you asking. Look, if I think about March, as I said in the opening remarks, it's robust. And actually, March has been a great month for us. It's been a record month for us. We sold more than 100,000 cars in the month of March for the first time in the company's history. And I would tell you, it doesn't really make sense to think about comps this year versus last year just because of the COVID impact. The way I think about them is we should really be comparing them to March of 2019, so 2 years ago. March of 2019 was the old record of number of vehicles that we sold. And what I'm most encouraged about is if I compare our March performance this year to 2 years ago, we're seeing double-digit growth on top of that March, which just really speaks to a lot of the things that are going on. I mean, sure, some of what's going on are macro factors beyond our control. When you think about the pushing of some of the tax refund money into March, you think about the stimulus, I absolutely get that. And that's helping drive some of that tailwind. But we're really excited about the tailwind beyond that. So we're, as we said in our opening remarks, we're excited about 2021. I think 2022, the FY 2022. The quarter Unfortunately, it's the ending of a very volatile year for us. I would just remind everyone, if you go back to FY20, it was a great year. Double-digit top-line growth, high mid-single-digit comp growth. We continued that into the beginning of FY21 up until the point we hit the pandemic. And then since the pandemic has been in place, it's obviously been a very volatile year. Looking at the fourth quarter, the pandemic also started to cause some of the volatility at the beginning of the quarter with the December. And we talked about that the last call. We had a big surge in COVID cases. And, we had a bunch of markets that went back into lockdown mode. I'll give you one example. The state of California, which has been typically one of the most restrictive states, limiting occupancy to 20 and 25%, that went back into that mode of 20-25% in December. A market like that, what we saw is that occupancy restriction causes that market to perform on average north of 10% worse than the rest of the organization. So we had that headwind on the occupancy restrictions in December and in January. Both of those 2 months, we had more than 50 stores that were less than 50% occupancy. And that, less than 50% is difficult for us. You get to 50% above, we can work through that. But just given the traffic that comes into our store, it's hard to manage that. But that being said, we started out December -4. We were able to do better than that at the end of this December. We were still negative. But then coming into January, and if I look at January, it was the most normal, if there is such a thing, normal month. We didn't have tax refund delays. We didn't have bad weather. What we really had to contend with were these occupancy restrictions. And even with the occupancy restrictions, we were seeing comps, north of 7% in January, which we feel great about. And I really do think that's continuing some of the trends that we saw in the prior year in our investments coming forward. Then we get into February, clipping along, and like I said in the opening remarks, we were looking, even though we started out in the hole, we were looking at a mid-single-digit comp, excluding the impact of leap day. Now, keep in mind, leap day last year was a Saturday, and our stores that's the busiest day of the week. So excluding that, we were mid-single-digit comp, and then we hit the weather constraints and just the delay of the tax refunds. I think in February, returns were down about 30% year over year. So that's a little bit more color on that. Let me pass it to John to talk about the other question.
Sure, Brian. Thanks for your question on the fees. So your question was, why now? And a fair question. I think really 3 things I'd point to there. First is I think it's just a very favorable lending environment right now. I think customers are performing well, and I think the finance companies and lenders are anxious to extend money out to customers that are performing well. It's absolutely a favorable funding environment. That's very clear. So those 2 things certainly made it easier. And I think all of our lenders in our platform are really excited about Carmax growth. So they're excited about what's coming in the future. They love Carmax collateral. So all those things together, I just made it feel like it was the right time. I think something I'd want to drive home, though, as we think about fees or our entire platform, whether it be the fees and discounts, the partners that we have in the platform, where CAP participates in the platform, the most important thing we're looking to deliver from our finance platform is highly competitive offers across the credit spectrum in all economic environments, and we want to do that such that we can scale that as Carmax scales. So we're always going to look at that platform and look to optimize it. It felt the right time to make the fee changes now, but we were very careful and looked at what the impact of sales were there. And if we make any changes in the future, we will stay very focused on providing those strong credit offers. So that's most important to us.
Hey, Brian, one more thing, too. I just want to point out, I talked about the occupancy restrictions. I'm going to knock on wood, but as of right now, although we have about 1/3 of our stores still in occupancy restrictions, the key factor is we only have 1 store at this point that's less than that 50%. And again, that's an important threshold for us. So.
I appreciate all the color. So, Bill, just to clarify, so the month of March, you sold 100,000 cars, if I heard that right. And that's up double digits from you're saying that's up double digits from what the number was for 19?
That's correct. And I think that's the way we should all be thinking about this year. I think trying to relate comps, this year versus last year, I think that's I just don't think that's a good exercise. I think we should relate it back to 19, which was a great year for us, and we sold a lot of cars. And so that's what's really encouraging is that you look at, because that March of 19 was the past record, and we beat that by double digits.
All right. Appreciate it. Thank you.
Thank you, Brian.
Your next question comes from Scott Ciccarelli from RBC Capital Markets. Please go ahead.
Good morning, guys. Bill, just can I verify the double digit you just referenced on Brian's question? Is that comp or is that total? That includes new stores?
That is both. It's both. It's comp and total.
Got it. Helpful. So especially since you are trying to help everyone understand kind of like the sales pace and variances, et cetera. Can you provide any more details on what you're seeing in the Atlanta market from a market share or sales perspective, just given the seasoning in your omnichannel offering? And kind of related to that, is there anything unique that you're doing in that market? Because at one point I know there were some unusual things you're doing with marketing and pricing that you hadn't rolled out everywhere. Or is everything kind of a blanket offer, blanket testing at this point?
Yeah, so Scott, on the Atlanta, as I said in the opening remarks, we actually maintained market share in Atlanta. And if I look at the fourth quarter, comps in Atlanta were actually about 6.5%. So we're encouraged by that. And look, we have some older waves that we rolled out Omni that also had comps in the quarter. But then it gets hard to look at the waves because the waves had some stores that were impacted by weather, some that weren't. So again, Atlanta's kind of the clean look at it. As far as different things, when we started doing the expanded pricing test and looking at the marketing, a lot of that was from the learnings that we had in Atlanta. So we're starting to put that out in other markets. I think the other thing to remember is when we roll new things out. So for example, if you think about self-serve, the first market we put that in is Atlanta. Generally, we roll things there first. So they're always getting things a little bit earlier than everyone else. So that would be the difference that I would point to as well. But on the self-serve, again, we're excited about that because I think the team has done a tremendous amount of work. We coming out of the second quarter, we've got 25% of our customers were available to use it, and we think that most of the customers by the end of the second quarter will have that option.
That's helpful. And just one more follow-up, if I can. Is there any demographic differences for people utilizing the omnichannel than what your typical customer cohort would be?
Yeah, no, it's interesting. We don't really see any big shift in demographics. It very much mirrors the typical CarMax customer that would come into the store.
Very helpful. Thanks, guys.
Thanks, Scott.
Your next question comes from Michael Montani from Evercore ISI. Please go ahead.
Hey, good morning. Thanks for taking the question. Just wanted to ask, if I could, where the self-sufficiency ratio was, for fiscal fourth quarter and then for the prior year, and then I had a quick follow-up to that.
Yeah, so Michael, the self-sufficiency for the quarter was it was a little bit above 40%, 41-ish%. And that's up from the prior year's fourth quarter where it was down in the 30s, mid to really kind of mid 30s, around 35 or so.
Okay, and then the follow-up I had was just to get some sense of magnitude on the potential tailwind to GPUs from self-sufficiency. I've been thinking of it as maybe $600 to $1,000 a unit, all else equal. And I guess I wouldn't insinuate that you all would flow all of that through, but it just seems like if GPU is still going to be down, even with that kind of a tailwind, it suggests that you're getting, really sharp on price and doing a lot of free transfers. So just wanted to understand how you think about striking that competitive balance as well.
Yeah, I mean, I think you bring up a good point. I mean, the more we can buy through the appraisal lane, it obviously is it's better from a profitability standpoint because if you think about it, you're not paying auction fees in a lot of cases. In all of the cases right now, we're not having to transport them from an auction; they're actually at the store. So we take that as part of how we manage our overall margin, and at times we'll take some of those synergies and we'll obviously pass along in prices, which would be really hard for you guys to see. Other times, obviously, we have the option to manage our margin and get to the margin where we want to be. So it's a balancing act, and it's one that we'll continue to take into consideration, as well as continuing to look at the macro factors as we go forward on our pricing tests.
Okay. Thank you.
Thank you.
Your next question comes from Rajat Gupta from JP Morgan. Please go ahead.
Hey, good morning. Thanks for taking my questions. Just to follow up on like the 100,000 number for March, you talked about some stimulus and tax refund shifts, maybe some recovery from the poor weather in Texas, some deferred purchases because of that. Like, is there any way to quantify how many of those 100,000 units may have been a shift from Feb to March, as you would see in any other normal year? And just could you give us a sense of the mix of alternate delivery channel volumes in the fourth quarter and in March as well? And I have just one more follow-up. Thank you.
Okay, Rajat. So as far as the sales shift, really it's hard to quantify, especially break it down between the weather and the delay in tax refunds. I think the best way to think about that is kind of how I talked about it earlier, that coming into February, middle of February, we would have, excluding the impact of the leap day, we would have been running about a mid-single-digit comp, and obviously that's not where we ended up. So that's one way to think about. We ended up in negative 2.3. That's one way to think about the weather and the taxes combined. But it's really hard to parse out, and it's hard to know exactly, obviously, how much is impacted. So as far as the alternative delivery, just to remind everybody, alternative delivery is both home delivery, but it's also express pickup or curbside pickup. We're seeing it's under 10% of overall delivery. And again, that's a number. While we have reported out on it, it's one that it's not like we're trying to drive that. Again, this is all about giving the customer the experience they want. And if they want home delivery, great. If they want to pick it up in the store, great. So, but to answer your question, it's under 10% of the overall. I think the other thing, Rajat, is the thing that I introduced, which is the online sales. That's kind of a new metric that we talked about on this call, and obviously in May we'll have more on these metrics. But 5% of our customers essentially did the whole transaction online, and then to us, we don't care how they get it fulfilled, whether it's in the store or if it's at home, and we expect that 5% to continue to go up.
Got it. And so just on the previous question, have you been able to gauge any impact from the stimulus package specifically that might have helped March, or any sense of that, like what kind of contribution that might have had to your growth in March?
Yeah, so obviously it's having an impact. Again, it's like the weather and the tax delay refund. It's hard to gauge, but I think the thing that we're excited about is you've got different ranges, and it's not an exact science, but we just feel like the increase that we're seeing is beyond the stimulus. It's beyond the weather rollover. It's beyond the delay and tax refunds, and it really speaks to all the investments that we've been making on so many different fronts, and that's what we're excited about.
Got it. That's helpful. And then just on the SG&A line, you talked about increased investment. The overhead cost bucket, moved higher sequentially. Our understanding based on some comments on previous earnings calls were there were some permanent reductions that took place there. So just curious how we should think about that line item specifically, going into fiscal 2022 and beyond. What kind of investments are going on there? Like how much is fixed versus variable, et cetera? Just any color on that would be really helpful.
Yeah, the way we think about it, now is absolutely the right time to invest in growing our business, and that's the path forward that we've been taking. The industry and CarMax, we're at an inflection point, so we believe investment is the right point in time. It is now. I think it's also important to recognize that the investments we're making are also impacting our appraisal and our wholesale business, which we have focused some of our investments on. And we'll be talking about that in the upcoming Analyst Day, we'll speak to how we think about SG&A in light of these investments that are really growing multiple components of our business, not just our used unit business. I would look specifically to answer your question, the other line in SG&A, that actually is where you'll find some of our strategic investments, and we expect that line will go up. It has been offset over the past year and will continue to be offset by efficiency gains that we have across the business and that we're always focused on. But that line item specifically tags to our strategic investments as well around technology.
The only other thing that I would add to that is, if all we were focused on this year was continuing our improving our omni-channel experience, you would have seen a bend in the cost curve from an SG&A standpoint. But to Enrique's point, now's the time to continue to invest, and we're investing in all different parts of the business. So, which is also why Enrique said you got to look at the kind of the 2-year 5 to 8 in order to lever. So I just wanted to add that as well.
Got it. That's super helpful. If I could just squeeze in one more on the Edmunds, you talked about like neutral from an accretion standpoint, including like the financing and the equity, I guess. Any way to think about like just like gross profit or like EBIT contribution from the deal? Will we be reporting that? Where will that go in specifically, or will it just be a separate line item or something? Just any color on that would be helpful. Thank you. That's all.
Yeah, we do anticipate that we'll be reporting Edmunds as an operating segment. So you'll have a view into certainly their revenue, which we announced today what their last year's revenue was, as well as profitability. What I tell you though is if you take a step back from a impact, accretiveness, dilution impact upon the transaction, it's really immaterial to CarMax. In the immediacy, what I tell you is that we expect to create a significant amount of shareholder value creation from the acquisition, and we expect that to start in fairly short order as well. We've been partnering with Edmunds and the great people there for over the past year at this point. So we are really familiar with what benefits we can both accrue from our relationship, and we decided to exercise our option and pull the full acquisition, largely because we've seen the benefits over the past year of our partnerships.
Your next question comes from Rick Nelson from Stephens. Please go ahead.
Thanks for taking the question. Good morning. Supply constraints are pretty well documented on the new car side. I'm curious how you see that impacting your business and any view as to when you think new car supplies will normalize and how that might impact when they do.
Yeah, Rick. Good morning. It's hard to know when the new car supply is going to continue to ramp up. I mean, they're obviously facing some major chip shortage. I think the tightening of the supplies is going to be around here for a while. That being said, I go back to some of our earlier comments, which is, we source a lot of vehicles through our appraisal lane, and the more that we do that, the better it is for the organization. So we don't rely on, the wholesale supply for all of our inventory, which, I feel like there's plenty of supply out there. You got to work a little bit harder, but I would add on top of that is, because we're buying so much to the appraisal lane, it doesn't really have that much of an impact on our business, other than it could cause the overall sales price, the average sales price, to go up for everyone.
Thank you. Good luck.
Thanks, Rick.
Your next question comes from Chris Bottiglieri from Exane BNP Paribas. Please go ahead.
Hey, thanks for taking the questions. So first one, I want to follow up on the tier 2, tier 3. Congrats on getting that lower tier 3 fee. It never made sense in the first place. But once we exit this bizarro credit world that we're in, where losses are lower, right, but higher unemployment, and things go back to kind of pre-COVID trends, do you expect the change in fee structure to stick? Is this permanent, or is this like, that was the piece that wasn't understood, whether it's environment driven or like moving forward in perpetuity with that 750 stick?
Yeah, I mean, thanks for the question, Chris. It's hard to say if it's going to stick. This is a very fluid environment. We're always looking to optimize the platform. Clearly, Clearly it's a very positive credit environment in which we're operating right now, but I think our lenders are in this for the long haul. They see the growth potential there, so we will work with them carefully and assess if the fee structure is correct. We don't expect it to whipsaw back and forth, quarter after quarter, but we will keep a careful eye on it. One thing I want to drive home is, again, our structures with our partners. We have many partners in place. They provide the quality offers that we are able to give our customers in all the economic times, bizarro economic times, and good times as well. So they have been critical to the success that we have had over the years, including the Tier 3 space, where we believe that is truly an incremental sale. So, we value them. We work very carefully with them to make sure that everybody's winning in this platform, and we're poised for growth. So we feel real good about our platform right now.
Gotcha. That's really helpful. And then my next question is on the allowance. Obviously, a lot of noise this year because of the loss environment we spoke about a second ago, and then CECL implementation. So can you kind of help frame for us, like, how to think about the allowance? Like, let's just say the world goes back to normal, credit losses normalize, CECL still intact. What would your allowance look like given the profile of the risk characteristics you're looking at today? Like, what's a normalized allowance for a kind of normal cycle? Like, what should that number look like? It's been just hard to forecast, frankly.
Sure. Yeah. So the metric that I'll point you to again is that reserve divided by receivables. It's 2.97% for this quarter. Remember, coming down from 3.17 the previous quarter. Remember, also in that metric is the Tier 1 allowance, the Tier 3 allowance, and the required recovery expense per CECL. So I would say we're still north of what we consider normal times. We've always quoted 2 to 2.5% for the Tier 1 business. Obviously, again, you get that Tier 3 and the recovery in there, but we're still north of it. And I would point you to that 2 to 2.5 for a Tier 1 business is probably where we would expect to revert back to when things go back to normal.
This concludes our question and answer session as we have reached 10 a.m. Those remaining in queue can reach out to Investor Relations to have their questions answered. I will now turn the call back over to Bill Nash for closing remarks.
Thank you, Carol. Look, we've covered a lot today. A few takeaways. One, we feel great about the trajectory of the business and the outlook for fiscal 2022. We think that the past investments, our current investments, our ability to quickly innovate on things like the online appraisal, innovate on things like self-serve, that it will create an omni-channel experience and a value proposition that's really unrivaled in the car industry and will allow us to capture and increase market share. We're excited about the Edmunds acquisition and working with that talented team to make both companies stronger. And finally, I look forward to our Analyst Day on May 6th to dive a little bit deeper into the business and discuss new metrics and share how we're thinking about the future. I also just want to take a moment to thank all of our associates for the contributions. This past year, it was extremely challenging for everyone, and our associates did a remarkable job of not only taking care of each other and their customers, but really helping us to innovate the company forward. And I'm tremendously proud of all their efforts, and I'm proud to work with all of them. And finally, to all of you on the call, we appreciate your continued support of CarMax, and we look forward to talking with you again at our Analyst Day on May 6th.
Ladies and gentlemen, this concludes today's conference call. Thank you for participating. You may now disconnect.